evening and welcome to the Money Show. I'm Kavita Thapliyal and this is the place where money stops being confusing and starts working for you, because let's face it, every decision we make, from the coffee we buy in the morning to the home we dream of owning, from planning our next holiday to securing our children's future, has one thing in common, that is money. Yet despite the role it plays in every chapter of our lives, very few of us were ever taught how to manage it, grow it and make smarter financial decisions. And that's where we come in. Whether you are just starting your financial journey, building wealth, investing for the future, planning your retirement, or simply trying to make your salary stretch a little further, this is your show. No complicated spreadsheets, no intimidating financial language, just clear, honest conversations about the decisions that can help you build a stronger financial future, because personal finance isn't just about numbers, it's about freedom. And this is the show where we also answer your portfolio queries. Just in case you want any help from our experts, do send across your questions on the WhatsApp number that's flashing on the screen, 865-797-4571. And we have an email ID, which is themoneyshow@etnow.tv. So as you know, it's a senior citizen special episode and we talk about various topics, and today the focus is on retirement. So picture this, you are flying at 35,000 feet heading towards your retirement runway. Early in the flight, you want maximum speed, but as you prepare to land, you need to slow down smoothly to avoid a catastrophic crash. That's right, in the world of investing, this automated autopilot is called a Lifecycle fund. It automatically maximizes high growth equity when you are young and systematically shifts you into safe debt as you age. No manual tracking, no emotional panic, but here is the million-rupee question. Where should you park your autopilot? Should you use the internal auto choice life cycle features inside the NPS, or should you buy a standalone mutual fund target date life cycle fund? One locks your money tight until age 60 and forces a pension. The other gives you total freedom but zero tax perks. Now, which glide path guarantees a smooth landing for your wealth? Let's crack open the hood and look at the maths. Joining me are Niranjan Avasthi of Edelweiss AMC, Kurian Jose of Tata Pension Fund Management, Anup Bhaiya of Money Honey Financial Services. Hi, good evening and welcome all three of you on this very important show. And before we bring in our heavyweights and I start questioning you guys, let us understand exactly what is on the table today, so that the viewers can actually figure out what's right for them and what is the aspect of the discussion that they want to know. We are looking at two distinct automated engines designed to protect and grow your retirement nest egg. Choice A is the NPS Auto Choice. We'll also be flashing a chart on the screen. Think of this as a government-regulated institutional lockbox. When you opt for auto choice inside the national pension system, you do not pick stocks or funds yourself. Instead, you select three preset paths: aggressive, which is LC75, moderated LC50, or conservative LC25. The system automatically tracks your age every single year exactly on your birthday. It sells a little bit of your equity and buys stable government bonds and government debt. It systematically cools down your risk profile as you age. Now, choice B is mutual fund life cycle funds. Think of this as an agile private wealth compounder. These are single packaged target date mutual funds. You select a fund based entirely on your target retirement year. For example, a target 2050 fund if you plan to retire 25 years from now. The fund manager runs the glide path internally. It starts heavily exposed to equity when the target year is far away and shifts continuously towards debt as that specific calendar year approaches. So the evaluation parameters that we have set today in this discussion to judge which engine deserves your monthly savings, our panel is going to evaluate them across 5 non-negotiable parameters. You have to understand what is it in for you. The equity ceiling, how much raw equity power do you get? NPS legally caps you're around 75%, whereas mutual fund life cycle can aggressively write equity up to 90-95% in your early working years. Liquidity and exit freedom, again a very important aspect for you. What happens at maturity? maturity. Mutual funds let you withdraw 100% of your corpus as a lump sum or via tax efficient systematic withdrawal plan. NPS locks your money tight until the age of 60 and forces you to use at least 40% of it to buy a monthly annuity pension. Now, rebalancing frequency, again, a very important strategy. How smooth is the glide path? NPS triggers a manual block rebalance once a year on your birthday. Mutual fund adjusts the portfolio asset mix continuously on a daily operational level. Cost and expense structure, how much are you paying? NPS is one of the cheapest financial products in the world with rock bottom management fees. Mutual funds charge standard expense ratio, making them costlier but offering greater transactional agility. Tax efficiency, where do you save more? NPS gives you an exclusive additional 50,000 deduction under Section 80 CCD, and mutual funds do not give that entry tax perk, but they shield you from forced fully taxable annuity payouts at retirement. Now that we have set the chessboard, let's bring in our masters to see which strategy wins the ultimate retirement game. So, Kuran, let me start with you. The NPS pioneered automated age-based asset allocation in India long before it became a buzzword in the mutual fund industry. For an average Indian saver who wants a stress-free and set and forget retirement, why is the internal NPS Auto Choice framework, especially the aggressive LC75 track, the most bulletproof engine ever built? What makes it mechanical, birthday trigger rebalancing superior to an active mutual fund?
So, Kavita, thanks for having us on your show. Prima facie, first thing, I don't think you need us experts. You seem to have cracked the entire idea of retirement, and hats off to you. You've been doing this for quite some time. Now, coming to your specific question, I think what is most important is that each of us, everybody needs to prepare for retirement. And in retirement, we need to invest into a particular asset class which has the highest probability of beating inflation. And that is the largest aspect that is tried to be covered. Now, people generally tend not to start investment, not because they do not have the money, but because they do not know where to invest or how to invest, and they generally find investment or finance very complicated. So that's where auto cycle comes in. Here, there is no requirement of a person to understand the intricacies of the capital market. What are the kind of equity stocks that is being invested into? Doesn't need to know the fixed income underlying instruments. Everything is kind of taken care by the fund manager. So the advantage here is that the entire asset reallocation that happens, which is a very important aspect of investment, gets done through an algo, and that gets readjusted every time with a birth date. So you start with a high equity allotment and coming down to a lower equity allotment. Yes, NPS has been doing auto choice as an option for a long time, and now there are four options. There's an aggressive, which starts with 75% equity. There's a moderate, which starts with 50% equity, conservative at 25% equity, and now you have a balanced life cycle fund, which starts with 50 and stays with 50 till you're 45, and then it dials down the equity. So I think prima facie, what's most important is that people should start investing, stay invested for a long period of time, stay consistently invested, don't be confused by jargon, and use the auto cycle as an option to invest and create a nest egg. And not stay out of the entire investment market because one doesn't understand what investment or what life cycle fund is all about.
That's the option you get in NPS. Niranjan, I'll come to you. Let's talk about the speed and the freedom. Very important. Under SEBI's framework, your target date life cycle mutual fund can launch up with an almost to 90-95% equity exposure for young earners, shattering the strict 75% legal ceiling inside NPS. More importantly, you give investors 100% of their money back at the end of the flight. Now, with zero forced annuities, again, a very important aspect. What if one doesn't want to buy that? Why should a modern growth-oriented professional compromise their early compounding and final liquidity just for a minor tax break over here, or maybe, not opt for any other regular mutual fund and go with this?
Right. So, thanks for having me, Kavita. See, very important aspect of investing and saving, especially for retirement, is changing gears. And you beautifully explain in the initial thoughts that you shared, that it is extremely important that you change your gears, when you are landing. Uh, Generally, by human behavior, when you invest in equities and your returns are good, uh, investors don't switch out of equity and don't reduce risk. And that is broadly, I would say, a major pitfall for a lot of investors who probably would be planning retirement, because till the time of retirement, or rather in the year of retirement, if you don't reduce equity or reduce the risk from your portfolio, and if that year or those couple of years are bad, your entire planning can actually go for a toss. And hence, equity allocation, or rather asset allocation, is extremely important. Now, there are multiple ways to do asset allocation. One, you do it on your own, one based on certain models, uh, and one which is, linked to your age or certain algos. Now, life cycle fund, which has been, introduced by SEBI, it's been a long wish for the industry and from investors as well, because today we are gearing up for retirement planning for next 20 years and 30 years. And what life cycle funds allow is to select from options that will be available there, and select whether you want to get retired after 20 years, 30 years, 15 years, 10 years. So there will be funds starting from 5 years to 30 years from each of these AMCs. And based on your own retirement goal, you can select a fund. Like NPS over here as well, the equity allocation will reduce gradually, and the allocation to debt and other asset class also increases. So versus a normal mutual fund, here what you get is a very disciplined way of asset allocation, of reducing your risk right from the age of say 30, 35 to the time when you're planning to retire. That is one. Versus NPS, uh, like we all say, one size doesn't fits all. A life cycle fund comes with multiple options. So imagine if someone is a 40-year-old and planning a 20-year retirement, or maybe a 50-year-old again planning for 20-year retirement, because maybe that person wants to work till 70. There could be multiple cases. So not everyone retires at 55, which basically is an assumption when you go for a NPS, because at 55 your asset allocation into equity reduces to 15%. But in life cycle, there is a lot of flexibility. You can, even if you are at 50 and if you want to start with maybe 70, 80% equity, and then gradually reduce it to say 15, 20% over the next 15, 20 years, you can have those options. If you are 40, you want to start with probably 60 years, and next 15 years you want to reduce it, those options will also be available. So there will be multiple options available. Most importantly, in life cycle mutual fund, you just don't get equity and debt. There are other asset class which are allowed. It can also have exposure to gold, it can have exposure to REITs, InvITs. Plus the equity portion of life cycle fund is much more flexible to invest in large, mid and small, versus probably any other option. So these are a couple of options. Life cycle fund is a gives you a defined asset allocation, but a lot of flexibility and power to choose what kind of asset allocation, especially what kind of equity exposure you want to start with. So that, I would say, is an additional benefit in life cycle funds.
All right. So maybe the next question to both of you would be like how to decide on the right kind of retirement corpus. But before that, Anup, I'll come to you because you are the bridge between the manufacturing giants and actual Indian households. You see the real behavior of investors when markets tank by 20%. Product sheets look great on paper, but when a client walks into your office looking for a retirement plan, how do you break this down for them? Does the tax deduction of NPS wins the day, or do families value the absolute flexibility and emergency access of a mutual fund life cycle fund more?
So thank you, Kavita, for having me here. And see, what is more important is, like, can we have both things? Because client want everything. He wants highest return with the lowest risk. he wants tax benefit, he wants liquidity as well, and he wants the best performing funds also. So can you have a maybe strategy for the client where you allow him to invest continuously? How can you instill a sort of discipline with him? At the same time, can you provide him the tax efficient product? Uh, and maybe a only product where probably you'll get a tax advantage on an EEE basis. But at the same time, you need to also look for what client may not look for, like maybe a inflation or his lifestyle. How can you make sure that over a period of time, clients should able to meet his or should maintain his standard of life, and his lifestyle expenses can be taken care of? And that's where I think it's not either or probably both product fits in the client's portfolio. NPS allows you to make sure that clients become disciplined in terms of regular saving. But at the same time, you have life cycle funds, which probably provides the growth in the client's portfolio and takes care, his long-term needs and protect the standard of life.
All right. So all important questions are answered, but then it's time for a short break. And post that, let's talk about the annuity. Let's talk about the tax benefit. And more important, let's talk about the retirement corpus that you actually need. How should you do the homework to get the right kind of figure for your retirement? All of this and more after this break. Welcome back. You're watching The Money Show. We are helping you decide your retirement corpus with the right kind of investment instrument, Lifecycle option under NPS or Lifecycle fund. We have our guest connected with us. And next question, Korean, is for you because let's address the annuity elephant in the room. Why should an investor accept a mandatory 40% annuity lock-in under NPS when annuity yields, we know historically, lag behind inflation?
Okay, good question. But let me try and address it in a particular way.
Okay.
So first of all, the minimum amount of equity annuity that needs to be taken has now been reduced to 20%. It is no longer 40%. It is 20%. So one can withdraw 80% of the corpus as a lump sum, and only 20% of the amount needs to be annuitized. Obviously, that annuity amount can be 100% as well, but the minimum amount is 20%. Now, I don't think annuity per se is a bad word. What tends to happen is, and I think the biggest issue that we're trying to address today is not just building up a retirement corpus, but also stretching the retirement corpus for a long period of time. Let's assume we retire, as Niranjan mentioned, at 40 or 50 or 55. Let's assume we retire at 60. The challenge today is you have to extend that money till 90 or 100 because our standards of living have gone up. We are living longer. So we have to ensure that the money stays with us till you are 90, 100 or even more. So what annuity does is it gives you an assurance that this amount of corpus will last for you with you till you are alive. So that is the best portion of annuity. It gives you surety. The whether it is mutual funds, whether it is NPS, they're all
Right.
invested into capital markets, whether it's
Right.
equity or corporate bonds or
Right.
GSEC. They
Right.
are all capital market attached, but annuity gives you surety, and I think
So, a
20%
surety in
allotment
annuity. I
into.
just have 3 minutes on the show, Korean, so I'll have to ask
Sorry.
Niranjan also. Niranjan, SWP. Having SWP will give us more money in hand than the annuity we get from NPS?
Right. Yeah, absolutely. But as he was explaining, the end objective is also extremely important. So if you are looking to create or leave out some legacy for your grandchildren, children, and also enjoy the fruits of your investment, probably then SWP is a good option. It also has flexibility to increase or decrease according to your needs. So SWP can definitely give you a larger corpus at the end, along with the flexibility to reduce or increase the amount as per your cash flow needs.
How much should be the cost factor of both of these products taken under consideration before investing? Anup?
Sorry, can you repeat once again?
Yeah, I was talking about the cost structure of both of these products. How should one take that under consideration before investing?
So obviously, cost plays an important role, but
Right.
cost alone should not, like determine in terms of the end goal. One should not forget the end goal. Like definitely, if you look at the NPS, it offers you the lowest cost, as you rightly said, maybe on the planet. But at the same time, if you look at the other opportunity on the life cycle funds, which already Niranjan alluded, like it offers growth, it offers flexibility, and most importantly, as Kurian said, like you will live longer. When you live longer, what you need, your money should not run out of like your nest. So I think cost is important, but not the only important factor when you choose any other investment product.
Life cycle fund under NPS or life cycle fund via mutual fund, how should you come down to that retirement corpus figure? If you can just give us a rough calculation that can help our viewers.
So basically, obviously, what you need to look for is you can have 40x of your monthly expenses, like as your retirement or your annual expenses on your retirement corpus. So there are two things can get taken care of. NPS annuity plan will take care your maybe a non-negotiable item, which your monthly expenses, your groceries, and stuff like that. But you also have a lifestyle expenses, and that lifestyle expenses also should get figured out from your life cycle funds. So these two products meet your two different goals, or probably solves two different problems. One on your regular expenses can be, that's where you get a regular annuity from the NPS, and the growth from the life cycle funds takes care of your lifestyle expenses.
Okay. All right, so targeted goal-oriented investments, definitely viewers have a lot of option, but a lot of homework to be done by the investor themselves to figure out which is the right investment options. And I know a lot of it has been left out in discussion, but then this was a time I had on the show. Thank you so much, all three of you, for being a part of this very important show today. And for our viewers, retirement or no retirement, always make sure that you have your portfolio in place which is aligned with your financial goals. And with that, it's a wrap on The Money Show as well. Thank you so much for watching. Goodbye.